ETFs for beginners. What are ETFs? Hello and welcome to today's video. This video is for beginners and will explain you all the basics about ETFs in about 10 minutes. If you want to know how to invest in an ETF, you can find the link to this video here. What are ETFs? An ETF translates to Exchange Traded Fund, and is an exchange traded fund that you can think of like a shopping cart. With an ETF, you're buying a shopping cart full of different stocks, bonds, commodities, or a combination thereof. It depends on the fund you invest in. So, ETFs have the great advantage that you can already diversify your portfolio well with one share, so you don't have to buy each asset separately. They are also exchange traded and can therefore be purchased inexpensively through an online broker. ETFs are available as accumulating, which means that the distributions become reinvesting yourself, or as distributing funds, which means that money is transferred to your account. Depending on whether you prefer the benefit of compound interest or the monthly distribution of the dividends, there are a wide variety of ETFs to choose from here. ETFs were introduced starting in 1993, with the first ETF on the market being the SPDR S&P 500 ETF. Since then, there have been thousands of different ETFs from a variety of providers. How do I buy ETFs? Feel free to watch the detailed and linked video. In a nutshell, you can buy ETFs through an online broker, through a bank, or through a financial advisor. In that order, expect rising costs, but at the same time, rising advice and support. Decide for yourself what you need. In any case, I advise using an online broker, as the fees here are comparatively affordable, and I believe that I should be very familiar with an asset class before investing financial resources. If you liked the video, we are always very happy if you give us a thumbs up and leave a comment for us. What are the advantages of ETFs? 1. Compared to other funds, especially actively managed funds, ETFs have low fees, which means your returns are less likely to be diminished. Pay particular attention to the TER, total expense ratio, which are expressed as a percentage and always refer to 1 year. The ongoing costs per year reduce your return by this percentage point. In this respect, ETFs are significantly more favorable than actively traded funds. The TER for your ETF should be around 0.18% to 0.2%. The lower this value is, the lower the costs are. However, you can of course include ETFs with a TER of 0.35% or 0.45% in your portfolio if you expect a high return and it fits your risk-cost profile. 2. ETFs offer a broad diversification of your invested money, as an investment is made in many different companies, sectors, and countries. 3. ETFs can be bought and sold on the stock exchange, so you are always able to trade flexibly during trading hours. 4. ETFs offer a wide transparency, as they have to publish their portfolio regularly. This allows you as an investor to understand and track exactly what you are investing in. In general, however, my opinion is, I don't buy anything anyway that I don't know the best about. Financial surprise eggs are usually a bad idea. 5. If you only own accumulating ETFs, you will have a good tax efficiency and benefit from the compound interest effect. Accumulating means that an ETF automatically reinvests your profits in the form of dividends by buying more shares in the same ETF. This way, you benefit from compound interest and your assets continue to build up independently, and you do not have to pay taxes until you sell your shares. Distributing, on the other hand, means that the dividend is transferred to your account in the month, and you then have to pay taxes on this dividend. 6. With an online broker, you can invest in an ETF from the comfort of your home, or automate monthly investments with a savings plan. 7. ETFs offer you many access opportunities, for example in real estate, commodities, or foreign markets, to which you usually do not have access. 8. ETFs and ETF saving plans have a minimum investment of $1 to $25, depending on the broker, so you can invest in ETFs with very small amounts each month. Thus, they are equally affordable for low-income earners or people with low savings rates. 9. ETFs usually have no minimum holding period. Therefore, you can buy and sell the ETFs whenever you want. However, ETFs are generally more suitable as a long-term investment. 10. Professionals can also go short, which means betting on falling markets and profit here. A leverage can also be set. However, I would only recommend these two options to you after 2 or 3 years of stock market experience, at the earliest, and only with sufficient expertise. What are the disadvantages of ETFs? 1. As with any investment, ETFs also have risks and disadvantages. You have to weigh the risks and chances of profits for yourself. ETFs are usually profitable as a long-term investment option. 2. Like other shares or funds, ETFs have fees, which are incurred when buying and selling the ETFs, as well as annual running costs. These vary depending on the provider. 3. If there are massive capital outflows, there is liquidity risk, where some ETFs may have difficulty paying out the amount of money investors demand. 4. ETFs specialize in tracking an index as closely as possible. Popular and well-known ETFs include the MSCI World, S&P 500, STOXX, and the MSCI EM. In rare cases, tracking errors can occur, meaning that the return of the index could not be replicated. Other factors, such as taxes and fees, have the effect of reducing the return. 5. As with other assets, in the asset classes of commodities or equities, ETFs are volatile and can change significantly in value. Depending on the demand and supply of the shares, the price rises or falls, just as the performance of the index plays a decisive role. ETFs are now available in a wide variety, so you have a very large selection. To go through and choose an ETF according to your risk management, your investment strategy, your investment horizon, and your return expectation can take a long and research-intensive period of time, where you really have to study ETFs intensively. 6. ETFs can be distributing or accumulating. This not only makes a difference on your wealth, but also on your tax situation. Depending on the country, the capital gains tax and withholding tax can be a different percentage and have an exemption amount up to which you do not have to pay capital taxes, but only withholding taxes at a lower percentage. The maximum rate in the USA is around 49%. For example, if you live in Germany and buy an American ETF that pays dividends, you pay about 15% withholding tax on the dividend to the US and about 10% to the German tax office. At $100, this already adds up to $25. Depending on where you live, it is worthwhile to claim exemptions beforehand and to be well informed about the tax situation on dividends and interest. 7. There is a currency risk with ETFs, which means that ETFs often contain international investments that are traded in a different currency. This can cause exchange rate fluctuations and a dip if one currency is hit by a drop in rates. If you want to buy ETFs exclusively in your currency, it is possible that you will incur higher costs. 8. ETFs can perform as well, worse, or better than the market. Again, profits are not guaranteed, and investing your money involves risk. 9. Because ETFs are funds that track an index, ETFs also retain shares of stocks that perform very poorly. This means that an active manager would have sold and replaced those shares long ago, for example. This can reduce your returns. 10. While ETFs provide diversification for your portfolio by investing in different companies, they do not provide individual diversification with your specific goals in mind. They also often have little diversification in terms of countries, e.g., the MSCI World currently has a 67.99% allocation to the United States, while the MSCI EM currently has a 29.13% allocation to China. Likewise, there may be an increased investment in one sector. For example, 21.77% of the MSCI World ESG is made up of companies in the information technology sector. Clusters in the ETFs can also be found in the healthcare sector or the financial sector. If there is an economic recession in the US, these ETFs will be massively affected. Here you should look at the composition of the ETF and select, for example, several ETFs to make a sector and a country diversification independently and individually. ETFs are in principle suitable for investors of any level of experience and, due to their wide range of options, also for any investment horizon. ETFs cover many wishes of investors. They are broadly spread and usually well diversified, have a cost-efficient fee structure, offer flexibility in buying and selling, as well as access to special markets, and can therefore replace or support the picking of individual stocks. However, ETFs also do not offer the ability to invest in individual companies. You can then choose this as a complementary strategy to ETFs if you wish. With the low minimum amounts of ETFs, you can also try trading here sooner than with more cost-intensive individual stocks. It is important to carefully consider your investment goals, risk tolerance, and financial situation before investing in ETFs. I hope this has been helpful to you. If you have any questions or ideas for future videos, let us know in the comments below. Thanks so much for watching.